Bitcoin and gold are two strategic monetary assets shaping the future financial reset taking place in the global economy. It is for this reason this channel is dedicated to Bitcoin (BTC) technical analysis, gold (XAU technical analysis, and how institutional capital moves between these two assets. In today's Gold Weekly Technical Analysis, we use our BCG Market Structure Simplified dashboard to get a snapshot of the current gold price action. The dashboard looks at three core areas: trend and swing direction, price movement and price zones, and current volatility. Gold structurally remains bullish with volatility compressing around the $5,000 price level. If you take nothing else away from today's video, these are the three gold numbers you need to remember. Consider it your cheat sheet. They are $5,700 resistance level, $5,000 equilibrium level, $4,400 support level. If $5,000 support fails, the market could rotate back towards the $4,400 structural support floor. In today's analysis, we cover where is gold now, which price level institutions are defending, which price levels could change the current structure. Welcome back. We are BitcoinCapitalGold. A global financial reset is quietly unfolding, with governments and major institutions positioning for a future where Bitcoin and gold form the foundation of the next monetary system, replacing our broken global fiat system. This channel's only focus is only these two assets, Bitcoin and gold, using structured technical analysis to understand market structure and how capital rotates between these two strategic assets. If you want to stay ahead of this far-reaching monetary shift, this channel is designed to help you understand it early. Let's get into it. The market phase is up. On every high time frame, yearly, monthly, and weekly, the trend and current swing direction remains up. Although bullish, what is overshadowing gold's price action are the three bars created on 29th, 30th Jan 2026 and 2nd February. We refer to this as the dominant range. Why dominant? Because every price movement has been contained between the upper boundary at the 29th January 2026 all-time high at $5,700 and the rapid two-day decline reaching a low of $4,400, which now acts as support. All price action since that date has been contained within this range. Until we break the resistance high or support low, we are trading within that range. Gold's battleground remains inside this wide dominant range, but we are seeing both resistance and support at the equilibrium price of $5,000, indicating institutions may be defending this level. Last week, week 11, saw Tuesday finish the day up after some buying pressure, but this was short-lived as the next 3 days into Friday's close reversed all gains, leaving the week pretty much back where it started. The ranges were small and nothing noteworthy. We saw a soft landing back by the end of the week to the psychological round number of $5,000. We will give you precise price levels when we cover the Fibonacci zones shortly. Price closed on Friday at $50.61, so almost exactly the $5,000 equilibrium level. Maybe next week, week 12, will provide some clear directional move either above or below that equilibrium level of $5,000. Above, and buyers will have control. Below, sellers will have control. However, that advantage only matters if they can hold their gains, or losses, and push past the equilibrium level to challenge either the structural high or low defined by the dominant range. What we do see on the daily chart within the dominant range is an uptrend building, a pattern of higher highs and higher lows, as long as it can hold above the last daily swing low of March 3, 2026 at $5,005. This pattern alone tells us buyers are gradually building strength. As a counterargument, price ended the week closing below both its weekly and monthly midpoints. In fact, the week's high formed by Monday high hit its head against its March monthly midpoint and fell back down. The Fibonacci zones gives us more clarity as to the price zones. The next important levels come from Fibonacci retracement zones. On the upside, the resistance zone sits just above $5,400. This area was tested by the March 2nd high at $5,434, but closed below the Fibonacci resistance zone. To date, it has not been able to reach this height. On the downside, the support zone sits below $5,000. This zone was tested on the 3rd of March and 9th of March 2026 and bounced higher. We closed last week on Friday testing this Fibonacci support zone again, but without conviction. Below that Fibonacci support zone, the major structural support remains the $4,400 floor of the dominant range. Volatility. What is volatility telling us? We measure volatility by the ranges. The monthly range is most informative. What we see from the January 2026 range, the range that created the dominant range, is the February and March compressing to smaller ranges. We are still only in the middle of March, so that narrative may change, but this tells us gold is compressing. The weekly is a mixed bag of ranges, so nothing we can draw from. Volatility is one of the best ways to judge the strength of a move. Right now, the data suggests the market is not expanding strongly in either direction. Daily ranges remain fairly average, while weekly ranges have expanded and contracted inconsistently over the last few weeks. This lack of sustained expansion tells us the market is still compressing inside the dominant range rather than breaking out. Another useful way to understand the current structure is to look at the market phase gold is currently operating in. Right now, gold appears to be in what traders would typically describe as a compression phase. Compression occurs when price continues to move within a clearly defined structure, while volatility gradually contracts and directional conviction remains limited. In practical terms, this means the market is spending time rotating between support and resistance rather than committing to a sustained trend. These phases are very common in financial markets and often occur after large directional moves as both buyers and sellers reassess positioning. What makes compression phases particularly important is that they often precede the next major expansion in price. When markets remain confined inside a structure for an extended period of time, energy gradually builds within that range. Eventually, one side gains enough control to push the market beyond the boundaries of that structure. That is essentially the situation gold currently finds itself in. The dominant range between $4,400 and $5,700 has contained every move for several weeks, and the market has repeatedly tried to move away from the equilibrium, but like a magnet, prices are being drawn back to the $50,000 price zone. During these environments, professional traders typically focus less on predicting immediate direction and more on observing how price behaves near the edges of the range. Repeated rejections from resistance suggest sellers remain in control, while repeated defenses of support indicate that buyers are still willing to step in. Perhaps the most telling sign from the weeks of March is that $50,000 is being defended by institutions. Another characteristic of compression phases is that breakouts often occur when the market least expects them. After extended periods of relatively quiet trading, a sudden shift in order flow can quickly push price beyond the boundaries of the range. This is why patience becomes particularly important in markets like the current one. Until price clearly escapes the dominant structure, the most reliable approach is to continue monitoring how price behaves around the key levels that define the range. In other words, the market is not yet trending strongly in either direction. Instead, it is building pressure inside a well-defined structure, and eventually that pressure will resolve with a directional move. With the structure and key levels now defined, the market can realistically unfold in three different ways from here. Scenario 1, buyers continue the move. The first scenario is that buyers continue their progressive swings higher, building above the balance point at $50,000 and begin testing the resistance zone at $5,400. If that level begins to break, the next structural objective would be the range high near $5,700. Scenario 2, range continuation. The second scenario is that gold simply rotates inside the dominant range. Markets often spend extended periods moving between support and resistance before committing to a breakout. In that case, we would expect the price to oscillate between the support near $5,900 and the resistance zone around $5,400. Scenario 3, support failure. If support near $5,900 fails, the market could rotate back towards the lower boundary of the range near $4,400, and a break lower would cause a major structural change. So the market remains balanced for now, but those are the three paths that price could realistically take from the current structure. Before we finish, let's simplify everything into the three numbers that matter most right now. If you remember only three numbers from this entire analysis, remember these: $5,700, the range high; $50,000, the balance point; $4,400, the range floor. Currently, gold has an upside bias. So the structure is actually quite simple. The dominant range is controlling everything between $4,400 and $5,700. The equilibrium of that range sits around $50,000, and gold is currently trading above $61 above this level, giving buyers a minuscule edge. Inside the range, the daily chart is building a sequence of higher highs and higher lows, suggesting buyers are gradually building strength. However, the next major test sits above price in the 5,400 Fibonacci zone, and support remains near $50,000, with the ultimate floor still at $4,400. Until price breaks outside this dominant range, the market remains in compression, and the eventual breakout from that compression will likely determine the next major directional move. From a BCG market structure perspective, the key elements remain unchanged. Trend remains up, key price levels are holding, and volatility continues to compress. And that's your market structure simplified view of gold. Every day, we publish a market structure simplified briefing on both gold and Bitcoin. Gold and Bitcoin are not competing assets. They are strategic levers responding to different financial conditions. Gold is asserting itself as the defining store of wealth of our era, reaching all-time highs against a backdrop of war, inflation, and institutional demand. Bitcoin is simultaneously rewriting its own narrative, no longer simply a speculative asset, but one that serious portfolio managers are beginning to position alongside gold. Understanding how these two assets interact is no longer optional. This channel is built to help you think through that decision with structure and discipline. If you found this video useful, consider liking and subscribing so you don't miss tomorrow's video. What do you think of the levels we gave? Do you agree? Do you have your own levels you're watching? We'd love you to share your thoughts. Comment below so we can all discuss. At the heart of the new global financial economy will be Bitcoin and gold. If you want to be ahead of the curve, follow this channel.